I'm Eric Wilkinson from Wolfman Options or Pro Trader Strategies. You can find me there as well at protraderstrategies.com. One thing I'm going to talk about here, you guys, is some real easy way to remember the Greeks. Now, when you're going through some of these different webinars, they're going to be blowing through some of these different names that you're going to need to know because they're not really going to go over them. So I'm going to go over some ways to really make these Greeks sink in your head and give you a couple ideas as to how I teach traders how to trade. I'm not going to give you guys, like in my trading classes and stuff like that, or my daily market commentaries, trades that I think you should put on, and that's because I don't know what is in your portfolio or your risk parameters. So I'm going to teach you guys how to trade. Kind of think of it as I'm teaching you how to swim. I'm not going to swim for you. All right, but let me get a couple of things out of the way. My name's Eric Wilkinson. Some of you guys may recognize me from different mainstream media and things of that nature. I actually started out trading in college with a psychology degree and then decided I wanted to switch it over to finance. After graduating college, I moved up to Chicago and started working on the floor. Worked on the floor for a little over, right around 20 years, I would say, but been trading for over 25 years altogether, and I've traded everything through stocks, financial, futures, commodity futures, currencies, and basically options on all these products. I'm sure you guys have seen this little disclaimer here. Basically, bottom line is do your own homework. Past performance of any trading system or methodology is not necessarily indicative of future results. All right, this is the Greeks. And what we're going to talk about here really quickly is how to remember these things. They all have their nuances and things of that nature, but how do we remember these right off the bat? So at first glance, when somebody's talking about it, we can relate to something we already know. And one of them is delta. And the way that I remembered delta was data, because there's so much diverse data produced by this one little number in the option montage. And when I talk about option montage, this is what we're talking about here. And we'll always see delta coming in here. And delta, you know, tells us so many different things, like I mentioned, and I teach, I can think of at least 5 different things that delta tells us right off the bat. But one of them that we know is this is the probability of our option strikes coming into the money at expiration by 1 penny, okay? So for instance, this 108 call in Disney, which is Disney right here, DIS, is a 42% probability that the 108 strike in the next 30 days will end up in the money by 1 penny, okay? That's at expiration, a 42% chance. Some of the things that I teach about probability and the data that is provided there is on the floor. One thing that we used to talk about was the probability within the next 30 days of our strike being tested. The market coming up and kissing us and then kissing our strike and then coming back away. That is 2 times the delta. So for instance, in the one we were just looking at, it's an 86% probability within the next 30 days that Disney will come up and trade in the 108 handle. Does that make sense for everybody? And please, I like to have this interactive. If you guys ever have a question, throw it out there in the questions box, because I'd like to tackle that before we move on, because I want to make sure everybody is clear concept before I go on. I don't want to lose anybody as we go. All right, so that's just one of those little nuances. It's 43% probability at expiration that this strike will be 1 penny in the money or more. The other thing is it's a 2 times the delta to give us our probability of being tested or kissed. Comes up and trades in that handle for a second and then comes back down. All of these things that I teach with this delta and all of these other little nuances is to help you guys stay mechanical. That's one of the things that I champion when I'm teaching, is we have to stay with the rules. I'm not going to teach you a bunch of my rules right now. Every single option strategy I teach has its own set of rules. And what those rules do is narrow down our search as to what option strategy is the best for that underlying in the environment that underlying is in. And I'll explain that a little bit further as we go. But delta, I want you to remember, is data. It gives us all kinds of data. It tells us probabilities. It tells us standard deviations. It tells us what our probabilities of being touched are. And you know, there's just so many things about Delta that I could probably do this whole webinar on Delta itself, or any one of these Greeks for that matter. All right, for gamma, think go to delta because gamma goes with delta. Delta is another nuance with delta is it also tells us what this change in our premium will be for the first dollar move. So when Disney moves up from 106.90 to 107.90, this strike price, our 108 strike, should increase by 43 cents. Now that's all other things being equal. We're trying to really narrow this down to see how each one of these Greeks affects the overall premium. I'm not looking about how each Greeks interact with each other necessarily other than with maybe gamma, but I'm trying to isolate these for you guys so you can see how they affect the overall options premium here. But delta increases the premium by the amount of the underlying. So for every dollar, this would increase by 43 cents. So if it increased by 25, this increased by 25 cents, this goes up by 25%, right? So it would go up by around 11 cents on the first quarter move higher. So we know that. The second dollar move higher from where we are would add in the gamma to the delta. So it'd be 50 cents the second move. The first dollar would increase by 43 cents. The second dollar increases the premium by 50 cents. Does that make sense? Is everybody with me on that right now? Delta is the first move. Gamma goes with delta on the second dollar move. Okay, so we just add gamma in for that second dollar move. It gives us an idea how our premiums will inflate or deflate for that matter, because the first dollar move down, we would expect this premium to go down by that same 42 or 43 cents depending. Okay, so from 106.84 to 105.84, this premium would decrease, the 108 premium would decrease by about 43 cents on that first dollar move. Okay. All right, enough about gamma and delta. Everybody's straight on gamma and delta. Gamma goes with delta, basically on that second dollar move, right? Theta is just time. You know, we have all these fancy words for it. I don't know why we couldn't have just put up there the English words for it, but at the end of the day, we came up with theta, and theta is time decay. So again, for every day that passes, our premium over here is going to decrease by that 3 cents, okay? It's just theta decay. For every day that goes by, it decreases by that amount. So it's time. Theta is time decay. Sorry, I tried to isolate my dog, and she is smelling something, I guess. All right, so rho. Now, rho is one of those ones, and I tweeted this out about a month ago, you guys. This is a funny one because there is a generation of option traders that have never heard or even needed to know about rho. But one thing to know is rho equals rate, okay? Or to think of rho as interest rates. Because when interest rates are fluctuating, our premiums are going to fluctuate with that rate change. Now, back in the 90s, when Greenspan was head of the FOMC, he would move rates by 1 percentage point at a crack. So rho was at the top of every option trader's mind. We see now there's an FOMC meeting. They come in, they release the results right around 2 o'clock. And I will tell you that meeting we had with Greenspan was the catalyst to get him to start, and the future Fed governors, to release the interest rate at a certain point, like a number, because that unexpected move could really hurt people. I mean, Fed Fund Futures is a $5 million contract for one contract. So we're talking people are trading thousands of contracts and trying to spread off risk. Well, if the Fed comes out and does something willy-nilly, that really affects everybody's premium. And at a point of crack, rho really becomes a major concern. Now, when we're tinkering at quarters, we don't have to worry about it right now, but going forward with interest rates, especially if you're trading further out on the curve, the longer duration options are going to be affected by Rho more. We can see Rho in here. Most options montages don't even include Rho. You got to add that in there. Rho is going to affect in the money options more so than out of the money options. And that has to do with the risk-free rate. If I can park my money somewhere where there's no risk for a higher return, then there's no reason to go in here, right? So it has to be made up for, and that's what happens with Rho. So Rho goes higher in the money because I can park my money in a treasury rather than in the stock, in a sense. But further out the curve, we can see this is a 5 just in the money, 5 cents increase for that first 1% move. So it's only going to affect me 1 penny on a quarter move, right? That's not a big deal. But we get out here, out on the curve, and we can see a 0.25% increase, 0.25 increase would increase this premium by almost 12 cents-ish, right? So we do have to worry about Rho, especially if we're trading out on the curve. So just keep in mind that Rho is more in the money and further out on the curve. It affects calls on an increasing interest rate. Calls increase, okay? Because that has to do with parking your money somewhere else rather than in a stock. So as interest rates increase, calls increase. Vice versa, puts decrease. And that also has to do with interest rates as well and shorting. I don't want to go into all those real details because, again, we could do this for about another 30 minutes talking about Rho. But just remember, this number here increases as interest rates increases by that 1 percentage point. So keep that in mind. Going forward, interest rates are going to be in flux. You're going to need to know that, especially if you're trading out on the curve, okay? And that's where you can find it. You just basically have to pull it up and add it to your list. But Rho, worth more in the money, because that has to do with the cost of not investing in a risk-free interest rate, all right? So Rho is the rate, the interest rate. Pretty simple so far, right? Okay. My thing will change. And Vega, if you guys have ever seen anything I've ever talked about, whether it be a daily market commentary or any one of my webinars, you will know Vega is top of mind. It is probably one of the most important things, maybe besides Delta in my mind, as to what to look for when entering any type of option strategy. And I go through these lists and I nail on Vega where volatility needs to be for, say, an iron condor, a butterfly, a short straddle, strangle, any of those things. Long, if you just wanted to get long options, what does volatility need to be in order to implement an option strategy? All right, so let's talk about Vega. It's volatility. It affects the options premium for every 1% increase in volatility. So we see volatility moving all around all the time. This is volatility for Disney. And I'm not talking, when I'm talking volatility, I'm not talking VIX, you guys. VIX is an indicator as to what volatility is doing across the board, but every individual stock has its own volatility. For instance, you know, Disney being a 20 IV could be very low compared to something else like Tesla. If we looked at Tesla, it's probably quite a bit higher on its volatility, and you can see Tesla is around 58. But that still seems pretty low for Tesla. You take into account some of these spikes. So every stock has its own volatility, and we need to know where its volatility falls in relation to where it has been in the past. That's one of the keys to trading options, because our options premiums are going to fluctuate, and we want to increase our probabilities of success. Therefore, we need to know where that is so we can take advantage of expansion and volatility or contraction and volatility. And the beauty in that is, if you do this correctly, you can be directionally wrong and still make money by playing the volatility correctly, okay? And I'm gonna go into heavy detail on the volatility because I think it's one of the most important Greeks to learn, especially as a newer trader. So we're gonna talk probably the rest of the time about volatility for the most part and go into some details as to how to take advantage of that. All right, pretty simple. Volatility, buy low volatility, sell high volatility. If you take nothing else away from here, buy low volatility, and that is implied volatility, you guys. That is this number at the bottom here. We want to buy it when this volatility is near its lowest area, in a sense. We want to sell it when it's near its highest. Now, we don't always know exactly where the highest high is or the lowest low is. All we really know is the further we get to that 100% on the high end, or the 0 at the low end, like some of these here, we know the probabilities are that the market is going to be turning. It's when it's really low, it starts to ramp up. When it gets really high, you get the volatility crush. We want to sell it high, get that crush. Sell it high, want to get that crush. Buy it when we start getting the ramp up, okay? We don't exactly know when that's going to happen, but we know when it's really low, the probabilities are that it's going to want to migrate back to the mean, okay? So buy low, volatility percent, sell high, implied volatility percent. Because the fact of the matter is volatility is one of the major components of options pricing and is probably one of those Greeks that will affect the options premium quite dramatically, even intraday, especially this year. We've seen volatility spikes and come off. We've seen the VIX spike up to 15, 16 and come back down to 12. Those intraday spikes are affecting the intraday pricing of your underlying. So this underlying might not even be moving, but volatility is going all over the place and you're literally trading volatility. You can do that with the way that I have set this up in order to increase your probabilities of success going forward. Volatility is paramount. I'm going to say this over and over. Volatility is different for every underlying, like I mentioned. The problem is we need to discern if that volatility for that underlying is low or high, okay? And this is easily calculated. You can basically even do this in your head. I'm not saying you have to come up with the exact same number or go out to the 100th decimal place. I ballpark this in my head a lot, so, and you can do the same. We have a fraction here, numerator, denominator. In the numerator, you take the current IV minus the low, take that sum and divide it by the sum of the high minus the low. That's pretty easy. That tells us where every individual underlying implied volatility is in relation to where it's been in the past, right? We were looking at Tesla and this, what was 50, something right here, this Tesla, oh, this is Tesla. So 50 is pretty high, whereas Disney was 20, and that would have been really low for Tesla. I mean, Disney doesn't even get up into those 50s usually. So just knowing this number over here on the side, the volatility of Disney doesn't really tell us anything, you guys. What we're really wanting to know is, are these premiums in Disney right now really pumped up for Disney, or are they really kind of cheap, right? Because that volatility is really what's making that premium move. And with Disney, we can see it's pretty low. So let's take that fraction in our head. Remember, it's the current implied volatility, which is 20, minus the low, which is, we'll call it let's call it 15, just because that's pretty close for math. So 20 minus 15 is 5. So in the numerator, we have 5. And we divide that by the high, which is 32, minus the low, which is 5. So we have 27, right? So 5 divided by 27 is going to give us right around a, what is that, a 20% or a 20 IV percent. We can go here and check the math on it real quick. 29. So my rounding is going to cause that to be a little bit different, but you can see that ID percentile is pretty close. I probably should have done the math on it with a calculator, but what did I say? 25 divided by 27 is 18. So my number is a little bit lower than theirs, but that's because I've rounded it off and didn't do all the exact. You get the idea. That's how this number is calculated through Thinkorswim. They're going out to the, you know, the 100th when we're doing this as percents and pulling that all in. But you can do that on your own, especially if your platform doesn't provide it. For some of my clients that are premium members, we throw out the code that you can put this over here in your watch list so you can keep an eye on it, because I trade specifically on this. Buy low. We buy options when they're really low, and we sell them when they're really high. That's the gist of the trading platform or trading rules that I have for volatility for the most part. Now, like I said, every individual strategy, I narrow that down a little bit, but this is to give you guys a ballpark as to what to do and what not to do when you're trading options, because I see it so many times online when people are talking about going out and buying calls and something, and I'm like, you guys, volatility is at its highest level for that underlying. That means all you're doing is buying volatility. If the volatility goes down, and even if the market's going up, you can lose money. And I'll show you examples of how that happens. As a matter of fact, I have an example from just yesterday that I saw that this rule came into effect. So when we're buying low, that means we buy implied volatility percent for any underlying when it's below 50. So when we're looking at my platform and we're looking at the options premium, down here, like I said, current ID below 50. So Disney would be an opportunity to buy options in Disney. I wouldn't be selling these because if volatility goes up, I could be directionally wrong. Those premiums inflate. I'm going to lose money. Okay. So anything below 50, I even stretch this out. If you're buying just calls and puts, I would go below an ID percent of 30, which Disney would still fit that bill. But general ballpark, always sell premium when it's above 50, always buy when it is below 50. And here is an example of what happened yesterday. So Macy's, ticker symbol M, this is a buy low when ID percent is below 50. I took this screenshot yesterday, and I wish, you wish you could always have a perfect example for everything, but I just so happened to look up, and we can see I was long, or I am still long, so I'm not trying to get you guys lemming off the cliff. I'm just giving an example. If we look at these Macy's August puts, all right, longer duration, it's a long 5 puts, right? You can see that on this intraday move, Macy's was up in price. If I'm long puts, I'm directionally biased to the downside, right? I should make money when the market goes down, but I've increased my probabilities of success because I bought this premium when it was really low. The market moves up. This is the current P&L, daily P&L is over here. I don't have all the things above to give you what it is, but this is daily P&L. This is current P&L. This is delta. This is what the change on the price is for the day, and it's up 6 cents on the day, but I'm up $33 on this trade. Why? We can go and look at a chart of Macy's real quick, and we can see I put this trade on like the 11th. I got the directional move, so that's helped me. But now, the last few days, I've gotten this move moving higher against me. But what's counteracting the premiums is this volatility is just a blip higher. It's just slightly going higher, but that is counteracting my directional bias. I bought volatility when it was super low to know my probabilities. I did it as a chart setup. I teach these things too. I saw the confirmation of a bearish trade, kind of like what Rob was teaching. These are high probability trades when you get up here at a top and you get these dojis, confirmation, I took a high probability trade, right? That aside, I increased my probabilities of success by making sure that when I did this trade for a directional bearishness trade, that volatility was real low. So if I was directionally wrong and volatility expanded, it wouldn't hurt me. And that's exactly what we see happening, showing up in the P&L. The market is going against me, but because I set this up with a high probability strategy and volatility really low, when volatility expands, I can be directionally wrong and still make money. Do you guys see the power in that right there? And of course, I didn't have a perfect example for sell high because it just didn't happen, but we want to sell implied volatility percent when it's above 50. And I would even say if you're a newer trader, I would try and go above like 75%. Same thing, buy below 30 to 15%, sell above, like 70% if you're selling options premium. One thing I didn't mention with ETFs, it's a little bit lower, and the reason why is the basket of good, right? Basket of goods. And all of their volatilities are going to have a tendency to offset one another. They're going to average each other out. So what we are trying to do here is compare apples to apples. With all of that being said, we need to accept a little bit lower volatility for an ETF because of all of those different ways that the market will ultimately settle down the implied volatility spikes and or lulls, okay? So let's go back to the, if you guys have any questions, please feel free to reach out at any time. So let's just go through this a little quicker with the platform here, you guys, because I know we did the slides. I like to play around on the platform. I think you'll learn a little bit more from it. All right, so we can look at this even on the Analyze tab. Let's just take this strike here. I'm just going to use the calls, and we're going to go in there, and let's say we were to buy the calls in here in the options. Now let's make it so we can see it as a one lot. It makes it a little bit easier to look at it on the Analyze tab. All right, so we can see that our risk is, that dollar we paid for it. Our reward is ultimately unlimited to the upside. But what I want to show you is if we got into this trade and the market didn't even move and we just had volatility, I bought this, so we want volatility to go up. What happens when volatility goes down? If you watch this purple line, you will see that our probabilities of success start going down immediately and we start losing money immediately upon entering that trade. This could happen intraday if you do this with the wrong volatility. We've seen this on the charts. A great chart for Disney. Volatility spiking intraday, back and forth. So we want to make sure that we are in a location where we have increased our probabilities. If we get in low, we don't care about these little spikes. One thing we don't want to do is get in when we know volatility is going to get crushed, right? So right before earnings, if you are long options, even if I'm long calls in this situation, I am probably doing pretty well, especially with volatility expansion. But the one thing I know is after that earnings, I'm going to get volatility crush, which all that premium comes out of it. I could have seen myself get into this trade right here, be directionally right the next day off of that earnings, but because so much volatility came out of my premiums, I would have been left with a scratch. Okay, so that risk reward doesn't work, you guys. Playing volatility when you know it's going to crush is not the way to trade options. Trade options when the probabilities are volatility is going to come out, and one of the few ways to do that is when volatility is very near the high of its range. You could even look at it like that, like where you're not even looking at math and saying, okay, well, the middle of the road's right here, and you can ballpark it. You can do that too. It's below 50 if you didn't want to do all the math. But I would suggest doing the math because every individual underlying or strategy will have different volatility coefficients to go along with it. For instance, buying calls, I would not buy calls or buy puts when volatility is trading around 47, because that's right in the middle. It could go either way, right? I only want it to go in my direction. So if I'm buying it, I want it to go up. All right, one thing about this, knowing when to buy options, when to sell them, be very careful about when you guys are out there, you know, you guys are doing the right thing by educating yourself. One thing I'll completely agree with the previous speaker was that always be wary of somebody that only talks about winning trades. If you guys watch my daily market commentaries or some of my trades that I talk about my losers probably 3 times more than I talk about my winners. We don't learn anything from our winners. From our losers, we learn how to stay mechanical and how to learn these different probability coefficients to know when we are right and when we are wrong. And that's what I teach in my classes, webinars, and to all my students, how to stay mechanical with that. And knowing when the probabilities are testing us, even with Disney being short the 110 calls during this rally, I knew the probabilities that I even just told you guys about. The delta is telling me the probability when I put this trade on was a 16% probability of the underlying finishing, you know, $10.01 at expiration. Knowing that kept me mechanical. I knew that my probabilities of being tested on that strike were 2 times that delta, so about a 32% probability. That's a much greater probability. That kept me in this trade a little bit longer in order to catch the bit of correction, okay? So I was playing this to the downside. I was directionally wrong, but volatility did help me a little bit. And my probabilities kept me mechanical. So you guys be wary of anybody that cherry picks all of their trades. You never see any of their losers. I talk more about my losers than my winners, to be quite honest. And pundits on TV, you guys, I worked on the floor, all right? And I can't tell you how many times I saw guys like this on TV telling people how to trade options or the market or any of that stuff. And they were literally talking the opposite of their position. And I have a story of, I was in the pit and I was in a brokerage group as well as, you know, we had dual trading so we could trade and do brokerage, but I was in a brokerage group and I saw a guy from, not on CNBC, but a guy from a very large trading firm literally going in there and talking about how the Fed was going to raise interest rates. And if the Fed raises interest rates, then the treasuries would go down. This guy had had paper in the pit in order to catch all of those people watching the news, slam the market down. He got out of his strategy while he was on TV. Literally saw that happening. This guy, similarly, is talking about how you should go in and buy call options before earnings, okay? That's all you need to know. This guy says buy call options before earnings. I just got done telling you, you're gonna get crushed in that strategy because you can be directionally right and still lose money. Here, you were directionally right and again, would have still lost money maybe that next day if you would have kept it. But 5 days beforehand, buy the calls, you're basically riding up that volatility increase. You're going to be happy even if the market doesn't change, but the day afterwards, you could see that premium be cut literally in half after the earnings happen. So stay away from that. Be very wary of the talking pundits on TV because a lot of times, especially if they're at a big firm, I will tell you, they very well may be either talking their position up or trying to get out of a position and throwing you into it, all right? So stay away from that. Follow people that are going to give you good trades and they're going to talk about the bad trades that they've done. You know, talk about their good trades, talk about their bad trades, and hopefully talk about their bad trades more often than they talk about their good trades, because that's where you are going to learn from your mistakes. You don't learn anything from being right. You just see it happen, you're done, you're out. When you're losing money on those trades, that's when all of these things really start coming together, okay? Because we want to take advantage of volatility crush. Does that make sense for everybody? On how to figure out volatility crush. We would not want to see volatility go from 20, let's say 28 to 20, or 28 to 18. We can see a 10% haircut on this premium. Let's just say it was one day. We can move this strategy one day out. It's not going to work out very well if I do that one day out. So let's just leave the days the same for this strategy. So we can leave that out one day. We only went 6% haircut here. I still have 4% more to cut that down, or at least 4% more to cut that down after the earnings. So you can see that even if the market didn't move, I lost quite a bit of money on this line lowering. That's just the premium coming out of it. You're going to lose about probably 30 plus odd cents on this particular strategy for that move. We want that volatility to go up, like we said. If I can just make this into a positive real quick. If we just make that a positive, we can see that that starts increasing. So we want to be in that trade like I had for Macy's, where you don't have to be directionally right, but you can see my probabilities are increasing, or the volatility increasing is increasing my probabilities of success on this particular strategy. You see that? So that's how I teach to trade options in a nutshell. Buy low volatility, and we talk about different options, strategies, the volatility that needs to go with them to increase our probabilities of success. Because you guys, we can pick a market direction, and that's the beauty in the markets, is they can go, it's a 50-50 probability that it's going to go up or down. We can't change that probability. All we can do is increase our probabilities of success by setting ourselves up for success at initiation. That's one of the few things we can control, you guys, when we're trading anywhere, is our setup. And when we set it up, we're setting that strategy up in an environment that is conducive to increasing our probabilities of success. Now, I know that seemed very highbrow what I just said there, but the bottom line is, when we're buying options, we buy low. And when that volatility increases, even if we're wrong, we see something like what we saw in this trade with Macy's that I just happened to look up and saw, oh my God, it's a perfect example for tomorrow's webinar. Macy's is up on the day. I'm bearish. I have a bearish market assumption and volatility because I set it up in an environment that increased my probabilities of success. I'm seeing all of that show up right here. Okay? So at the end of the day, this is what we're giving you guys. You know, I gave you guys some little nuggets on how to trade options. I go into detail. I don't know if you guys saw any of my charts, but I show you how to set up my screen to trade options like the Wolfman. I also talk about that blue screen on the side. I trade around that. That's the market profile. I show you how to trade around that because that also will help you increase your probabilities of success. I go into a little bit more detail on how to use gamma. One of the things we were talking about, protecting your portfolio against rising interest rates. I'm not talking about row here, you guys. What I'm talking about is the interest rate portfolio, your bond portfolio. Most people have somewhere between 30 and 50%, maybe even 60% of their portfolio in treasuries some way or another, whether it's the overnight rate or a short-term to 30-year. All of those will be affected because as interest rates go up, the price of that bond goes down, and you can't chase yield, you guys. You can't just sell out of those bonds and go and buy the next bond because it's got a higher yield. It'll take you like 8 years in order to make up that deficit in what you had to sell your bond for at a discount to what your trying to recoup in your coupon payment. Traders are pretty savvy, you guys. You're not going to scalp them on this ARB, all right? Meaning you're not going to be able to sell your bonds at a higher price and make up for it in a coupon. They know that game. They know they need to price it lower, so you have to give up that edge, okay? Don't give up that edge. Watch this webinar that I talk about on protecting your portfolio. That will give you the supplemental income of that coupon, and you'll protect your portfolio. You'll be a lot better off for sure. Or I can't say for sure, I can't give any guarantees, but you will be a lot happier, I would bet. All right, so check that one out, protecting your portfolio from rising interest rates. Very, very important. For 36 bucks, it's in the chat windows. Sorry, you guys. It should be over there in the chat window. I can't get it to pull up, but I think it's over there. I think I see it in there. So take advantage of that, especially if you learn anything. If you learn one little nugget about trading options to make this a little bit easier, I go through, and even if you're a savvy trader, will give you some takeaways in each and every one of these videos, which is over 10, maybe 15 hours. And the beauty in it is we set it up so you can go in there and you check off the box so you know you've done it. You don't have to go exactly in order. If you wanted to come in, hey, Wolfman said rising interest rates, Fed's expected to raise interest rates. I need to take advantage of this one right away and watch that one, and then play around with those, okay? So you guys can take advantage of this for 36 bucks. Normally it's almost $1,000. And check out some of the market commentaries. You know, if you want to see how I talk daily, I go through the data. I talk about what's going on geopolitically, talk about the markets, crude oil, gold, all of those go through where I think their directional moves are going to be based on the charts and other ancillary things like geopolitical stuff. And then go into all my trades, whether I made money or I lost money. The day I put them on, the day I take them off, okay? And in between, I talk about, all right, you know, I'm trigger happy on this one. I've got a quick trigger on this. If it goes above this level, this is where I'm getting out, you know. And I talk about how to stay mechanical by writing all this stuff down to keep track of all your stuff. So watch those videos, and hopefully you can get something to take away from there. See a bunch of people are blowing me up. Thank you. I appreciate it. Thanks, HH. And I'll throw it back to Tanya, and I guess I'm finishing up a little bit early, maybe get that next guy ready to go a little bit sooner, I guess. I had a couple minutes to spare, so I can answer a couple questions here real quick if you guys have any. Otherwise, I'm going to finish up a little bit early. Because at the end of the day, one of the things you guys are doing the right thing by learning, and I always champion that. The best way to become a consistent trader is to learn, and you guys clearly done that. At the end of the day, though, just trading on technicals and assumptions isn't going to be enough to really get ahead in this game to increase your probabilities. But the way I teach it is how to build these strategies in high probabilities, or with high probabilities, even higher probabilities than what you're seeing with just Delta, because Delta tells you certain things, but I can teach you ways to set these up with higher probabilities, and when the probabilities have gone against us, when to stay mechanical and how to increase those probabilities by staying mechanical. That's the only real way, you guys, to create alpha. So when you guys are using the right tools in the right situation, you guys are going to be in a more productive state of mind. You're going to be able to put on more strategies, which creates more opportunities and ultimately builds confidence, all right? I teach that all the time. Even if you put on a strategy the first time and those probabilities go against you, stay with it because you know the probabilities are in your favor. If you guys, some of my guys, HH I know has been around for a while. He's one of my regular clients. He saw me go through earnings. First couple of earnings trades I did win against me, but I was like, hey, I'm scot-free for the next couple weeks because the probabilities will be in my favor. All right, so basically, guys, follow me. You can follow me on Twitter at Wolfman's blog. You can follow Pro Trader Strategies at Pro Trader Strat for different types of market wisdom. Also, later webinars, I'm going to be drilling down on different option components, trades, when and where I find them. You can also use this link if you're watching this on the tape delay for those who have been participating in this particular trader talk. So you can You're gonna have to pause it though if you're watching this on delay. It's not a hot link, but type that into your URL. If you have any questions, contact me at 310-598-6677 or email us at trading@protraderstrategies.com. All right, I'll throw it back to you, Tanya, and that's about it for me.